We see a bit of a reversal in the market at the moment. Those stocks that were up in the green yesterday are now down in the red, and those like the semiconductors, Nvidia, that were down yesterday are very slowly starting to recover. Now today we want to jump into 6 dividend stocks that have been suffering in the shorter term, understand whether we should be adding these into our portfolio, and a very high level look as well as getting to our own valuation. So the first one is Lockheed Martin, the defense giant. Now it is up around 10% over the last year. We're not going to go into the reasons why it is down 6%, it is the earnings, but what we're going to cover is the metrics, whether or not it's a great opportunity to buy, and as we can see, over the last 6 months, it is down around 11%, over the last 10 years, up around 150%, not too far off the S&P's performance, trading right now at the lower end of the 52-week range, with a double buy from both Seeking Alpha as well as Wall Street, and they do currently offer a dividend of 2.62%. Now looking at their earnings, we can see over the next 4 quarters they're expecting 2 growth, 2 of them to be in fact in the red, and over the last 4 quarters they have had substantial beats, 4 out of 4, 100% track record, and based on the EPS estimate for 2025 of $28, the forward PE does sit at the 18.03 mark. How does that compare? Well, that is lower than the sector median, meaning right now if you are buying this company, you're getting a 10% discount, but bear in mind their 5-year average has been lower, so actually it sits around 15% higher. But if you do want to use a different valuation metric, you will get to a different response, both in comparison to the sector as well as their 5-year, hence why they do get the overall C grade. In terms of the growth, they get a D. Now year on year, 5.33%, that is better than the sector as well as better than the 5-year average. However, we do notice forward looking over the next 12 months, 4% growth, lower than the sector at 5.4%, but marginally higher than their 5-year average. And the one criteria we do really like to pinpoint here is the earnings per share over the next 3 to 5 years. Very poor at 3.1%. That is significantly lower than the 11.5 for the comparative, as well as lower than their 5-year average of 5.85. Now, one area they do excel at is their profitability with the A+ score, and whilst we do notice the gross margin is 12%, significantly lower than the sector of 32%, it isn't too far off their 5-year average, so this is something they have had for quite some time. Bottom line, same to be said, 9.4%, pretty much in line with their 5-year, but actually it does steal the show as it is a lot better than the sector at 6.5%, and also the cash this company does generate from operations, 8.31 billion, well above the sector's 337 million, and not far off the 5-year average, so in fact you could argue this is quite a consistent company in generating their cash. Now for each one, we are going to run them through dividend yield theory. Now this tells us the company is undervalued as the yield does sit above the 5-year, however the forward P of around 17.1 is above their 5-year rolling as we mentioned earlier, so 2 conflicting metrics here, which in total we would say solely based on these metrics it does look to be reasonably valued. As we said though, we will run it through our own process too. In terms of institutions, 74% ownership, 6.6 billion worth of sales over the last year, with a very similar figure in terms of the buyers, so not too far off either way. However, we should point out here that in the most recent quarter, Q4, institutions did sell more than double the amount of buys. Remember though, always do your own due diligence, never copy what the institutions do. And now looking at it from an intrinsic value perspective, we get to $548, the average of these 3 models that you do see on screen. Now if you are someone that's a regular viewer, you know that we typically talk about the inputs and outputs. We're going through 6 dividend stocks a day, so jumping straight through it, we always apply a margin of safety, starting off at 10%. Now we do accept this as a buy up to $493 if that is sufficient for you in today's episode, but as we always do, keep going till it's near the current trading price, and right now we see a bang on 15% margin of safety. Wall Street, with their buy signal, they see this at $556 over the next year, which does translate to 20% upside. And as always, do give us your thoughts about these 6 stocks as we go along today. Now, before we jump into the next stock, we do want to let you know we have released our latest free weekly article yesterday. In fact, we drop one every single Monday morning completely free to your inbox. So click below, you can sign up and read straight away, where we talk about severely undervalued stocks as well as what's gone in the market over the last few days. and you will be able to grab a copy of 46 undervalued stocks for the month of January. Lots of information, upside that Wall Street themselves see over the next year, and over the next days we will be releasing the February copy. On top of that, you can grab a spreadsheet here of 43 stocks that Wall Street themselves believe have the most upside right now in the S&P 500, so click below, sign up and read straight away. The next stock we have is Nextera Energy, down around 4% today over the last 6 months, also in that downward trend. However, over the last 10 years, again up 168%, not far off the S&P during the same time frame. Right now, sitting in the midpoint of the 52-week range. All three analysts consider this company a buy as of today, and we can see the forward yield does sit at 2.8%. In terms of their earnings, over the next 4 quarters, they anticipate 3 of them to be positive growth, and over the last 4, at a bare minimum, they have been in line. Right now, based on the EPS estimate for 2025, the forward P sits slightly above the 20 mark. How does that compare? Well, the sector actually sits lower, so you are in fact paying a 15% premium. However, nice to see, it is quite low in comparison to their 5-year average, currently at 14%, although the other metrics here are in the red, given the fact it does sit on every single one higher than the sector comparative. Then we take a look at their growth, where they get a B-. Now, year on year is negative. Now, whilst the sector is also negative, it is to a much higher degree. The last 5 years for this company have been positive, so that isn't a good look. However, over the next 12 months, they expect growth, 4.8%, which is above the sector median, but still below their 5-year comparative of 10.2%. In terms of the earnings per share, well, 8.3%, a double good sign, well above the sector comparative of 6.8%, and pretty much in line with their 5-year rolling. Profitability at an A, gross margin 60%, better than the sector, also better than their 5-year average. Bottom line, 28%, better than the sector comparative, again better than their 5-year average, and we can see this company does generate a lot of cash from operations, 13.3 billion, a lot higher than the sector, as well as higher than their 5-year. So lots of good signs here to see for Nextera Energy. On top of that, a double undervaluation signal with the yield above the 5-year, as well as the forward P sitting significantly lower than 27.1. So all signs for Nextera Energy do point to current undervaluation, and institutions currently have around 79% ownership with 5 billion worth of sales, although nearly double that amount over the year. And we do point out that in Q4 we did actually get more selling than buying, quite a constant theme we do see across the board in terms of all stocks in Q4 of 2024. In terms of the valuation, we get to $82. Now when we do look at the margin of safety, you're getting at least 10% at the 15% point, not far off, you could argue, at that 70 mark, 15% MOS. Wall Street themselves with the buy rating fairly bullish, $88 over the year with upside of 24%. Continue on, we have Merck & Co. down nearly 1% today, but down 20% over the last year. Over the last 10 years, up around 66%. It has underperformed the S&P, trading right there towards its 52-week lows, but we see Seeking Alpha giving this a strong buy, Wall Street also giving this a buy rating, with a yield on the higher end in comparison to the previous two at 3.3%. In terms of earnings, well, 3 of the next 4 quarters, they are expecting growth. At a bare minimum, they have been in line over the last year, and in 2025, the forward P is expecting to sit around 10.5. In comparison to the sector, that is much lower, so you are getting a 39% discount, and it is also significantly lower than their 5-year average by around 30%, hence the A+ valuation grade, and something we see for the majority of valuation metrics today. In terms of the growth grade, well, they get an A, 6.5%. Bear in mind that's lower than the sector as well as lower than their 5-year average. In terms of the next 12 months, 4.4%, again lower than both the sector as well as the 6.13 from their last 5 years. In terms of the EPS, though, that does really shine through with 36% expected over the next 3 to 5, a lot better than the 10.3% as well as the 16.6 in comparison. In terms of their profitability, an A+, very impressive, 77%, well above the sector, marginally higher than their 5-year. Bottom line, again, looking very impressive at 19.2, given the fact the sector is losing money, -5%, and also marginally higher than the 17.7 from their average. Cash from operations equally as strong, 18.3, sector burning cash, -15 million, also higher than their 5-year of 14.8. We also notice the double severe undervaluation signal, 3.33 above 3.01, 11.2 below the 13.6. Institutions, we see 76% ownership, 8.8 billion worth of sales, more than 10 billion worth of buys during the same time frame. But again, we do have to highlight here, in the latest quarter, as we've seen so far today, institutions have been selling more. In terms of the valuation, $126 with the current price, meaning a very nice margin of safety today, something we have seen for quite some time. 25% would be a buy around $94, $95. Right now though, at the $100 mark, 20% upside, Wall Street themselves $125 by the end of 2025, giving them 29% upside. And do give us your thoughts, maybe you have been starting to buy some of these in the year. We then move on to our first REIT, Alexandria Real Estate, which is down nearly 4% today, down 22% over the last year. Over the last 10 years, up but only 4%. We can see all-time highs. We are talking quite a few years ago at $223, trading at it or near its 52-week low. A strong buy from Seeking Alpha, a buy from Wall Street, and the highest yield seen so far today at 5.2%. In terms of their earnings, well, no surprises then if they have been downward trending. The next 4 quarters are expected to be a decrease, but nice to see over the last 4, at a bare minimum, they have been in line. And based on the funds from operation estimate, the P to FFO does sit just below 11. Now, in comparison, we can in fact see for this metric here, it does sit lower both on the P to FFO as well as the price to adjusted funds from operation. So that is why we are seeing the B rating here, showing a discount of between 14 to 19%. In terms of the growth over the last 3 years, it does sit higher than the sector median. If we were to expand the net to the last 5, it does come in only marginally lower. Then we can take a look at their profitability, where they get a B+, but notably their cash from operations, $1.66 billion, does sit significantly higher than the comparative of the sector at 236. We also notice dividend yield theory clearly showing undervaluation, as well as the fact this is the highest yield the company has offered over the last 5 years. And when we look at the institutions with ownership of 97%, yes, they have been selling around 1.3 billion, but they've been buying more than double. And we can also flag here Q4 more selling than the buying. In terms of our intrinsic value at $124, very similar to Merck & Co, there will be a very nice margin of safety, 20% with the upside around 23%, $122. So far in this episode, Merck & Co as well as Alexandria Real Estate Equities do look like possible good opportunities. We then move on to Texas Instruments, down around 3% today. Over the last 6 months, it is down 10%. Over the last 10 years though, it has outperformed the S&P up 234%, trading in the mid to lower end of the 52-week range. All 3 analysts for the first time today have given this a hold rating. Wall Street 3.47, not far off the 3.5 for a buy, and in terms of the yield, just below 3% at 2.91. We can see earnings moving forwards are expecting 3 of them to be growth. Bear in mind, fairly cyclical industry, and over the last 4, they do have a 75% track record, with December 2025 EPS giving this a forward P sitting right now at 34. If we do compare it, that is significantly higher than the sector median, 35% premium, and significantly higher than their 5-year average, in fact 31% to be exact. Growth not looking good with the C rating, cyclical industry, but still negative 11%, lower than the sector of 4.5, also lower than their 5-year average of 2.4, and moving forwards, not good either, 3.5%, sector higher, although it is marginally above the 5-year 2.74, and we can also see here, they do come under with their earnings per share, 10.2%, sector at 15.24, however, it does sit higher than the 6.93 of the average. Profitability looking good, like most companies in this industry, at the A+ rating, 58% gross margin, above the sector, however lower than their 5-year. We then notice their bottom line, 31%, a lot better than the sector, however not as impressive as their 5-year average, and the cash this company generates from operations of 6.3 billion, whilst above the sector of 96 million, it does come shy of the 7.27. We do notice an undervaluation signal on dividend yield theory, however the forward P does sit considerably higher than their 5-year average of 24.6. Institutional ownership 85%, yes, 8.7 billion worth of sales, but marginally more buys over the year. Interestingly though, for the first time today and in quite some time on this channel, we do notice in Q4 institutions have been buying more, pretty much more than 4 times than they have been selling. If we were to look at the valuation aspect, this is one company where, similar to Wall Street seeking alpha and quant, we don't believe it is a buy. In fact, our intrinsic value is below the current price, meaning it is trading at a premium. If, however, you want to see at the 10% MOS, also bearing in mind you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for TXN or any others. 10% gives you a buy around 147 and at the 20% around 131. As we said though, no margin of safety. Wall Street with their hold rating see this at $207, upside of 14% at the end of the year. We then move on to Digital Realty Trust, down 4% just today. Over the last month, down nearly 10%. Over the last 10 years, up 128%, trading in the mid to lower end of the 52-week range with just one buy rating coming from Wall Street and a yield below 3% at 2.96. If we look at their earnings, they do expect growth over the next 4 quarters. Over the last 4, they have been in line or beaten 75% of the time, and the FFO estimate does give the forward P to FFO right now at a 23.31 rate. Valuation grade not looking good at all with a D-. If we do come down to the price to adjusted funds, we can see this does sit well above the sector comparative, in fact a 67% premium. Growth coming in at a C, we can see pretty much flat over the last 3 years, and over the last 5 years, again, not looking good at all when the sector, even though it is low single digit, does come in at positive. In terms of profitability, they get a C-. However, we do note they generate a significant amount of cash from operations, 1.95 billion, with the comparative at 236 million. We do also note 2 reasonable / slight overvaluation signals when we look at dividend yield theory as well as the forward P to AFFO. And if we were to look at institutional ownership, nearly 100%, 2 billion sold over the last year, and we can see more than 3 times buying, and not too dissimilar in Q4's movements. Jumping into the valuation today then, $181. When we do run it through the MOS, you are getting at least 10% up to 163, at 15 around 154, so sitting somewhere in between those numbers, with Wall Street themselves a $203 price target, 27% over the next year, so they do consider this a buy. However, we only see 10% MOS, and do give us your thoughts below. Don't forget to subscribe to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we do cover our weekly buys and sells. We have just made some over the last few days, and have a great day. We'll see you all on the next one.